The first time the stock dropped 10%, I smiled. I had been waiting for this. Everyone online kept repeating the same three words: buy the dip. So I bought the dip. Then it dipped again. So naturally, I bought that dip too. Then it dropped 40%. And somehow I convinced myself I had discovered the clearance section of the stock market. By the time the stock had lost more than 90% of its value, I was still buying. At that point, I wasn't catching a falling knife. I was collecting the entire knife set. But the strangest part is that I didn't lose my money because I panicked. I lost it because I refused to admit I might be wrong. And every time the stock fell, I made the exact same mistake, just with more money. It started with a company that seemed impossible to ignore. People online called it the future. The company had an exciting product, a charismatic chief executive, and enough ambitious promises to make a science fiction movie look conservative. Every video about it said the same thing. This company is still early. This could be the next 10 times stock. You'll regret not buying now. Nothing creates calm. Rational investing decisions, like a stranger yelling that you'll regret everything. The stock had already climbed hundreds of %. But investors insisted the real growth hadn't even started. I watched interview after interview. I read articles. I joined online groups where people talked about future factories, huge contracts, international expansion, and products that didn't technically exist yet. Everyone sounded extremely confident. And confidence is contagious even when nobody knows what they're talking about. After a while, I stopped asking whether the stock was risky. I started worrying that I was going to miss it. I invested $1,000. Not enough to ruin my life. Just enough to check the price every 7 minutes. For the first few days, the stock went up. My $1,000 became $1,100, then $1,200. I immediately felt like Warren Buffett with a smartphone. I told myself I had done the research. I told myself I understood the company. But the truth was much simpler. The price was going up, and rising prices make everyone feel like a financial genius. Then the stock dropped 8% in one afternoon. I expected to feel nervous. Instead, I felt excited. This was the opportunity everyone had promised me. My first real dip, so I added $500.com. The stock bounced the next morning. I made money almost immediately. And that small recovery taught me the most dangerous lesson possible. Every drop was a buying opportunity, or so I thought. A few weeks later, the company released disappointing results. Revenue missed expectations. Losses were growing. Management delayed an important project. The stock dropped 18%. For about 30 seconds, I considered being responsible. Then I opened the online group. People were celebrating. Thank you for the discount. I'm loading up. Nothing about the long-term story has changed. Apparently, losing money was now a community event. Anyone who expressed concern was attacked. They were called emotional, weak, short-sighted. One person posted a very long explanation about why the terrible report was secretly good news. I didn't understand most of it, but it had charts, capital letters, and several rocket emojis. That was apparently enough for me. So I bought another $2,000. My average purchase price dropped. That made me feel better. I wasn't losing more money. I was improving my cost basis. That sounds much more professional. But lowering your average price doesn't repair a broken investment. Sometimes it just increases the size of the mistake. Soon, owning the stock became part of my personality. I knew every interview the chief executive had given. I followed every announcement. I defended the company in comment sections, like I was being paid by the legal department. When someone criticized the business, it felt personal. Weak sales, temporary, rising debt, investment in growth, management selling shares, probably needed grocery money. Another delay? Better to do it correctly than quickly. There was always an explanation. And whenever the price fell, people repeated the phrase that had worked once before: buy the dip. The stock dropped 30% from its high. I bought. Then 40% come. I bought again. Then 50%.com. By that point, I had invested almost $10,000. Most of my savings were now in one company. But I didn't call it concentration risk. I called it conviction. Conviction is a wonderful word because it can make a terrible decision sound brave. That meant existing shareholders would own a smaller percentage of the company. The stock collapsed again. Even some of the loudest optimists became strangely quiet. I looked at my account. My $10,000 was worth a little more than $5,000. I felt sick, but selling would make the loss real. Holding allowed me to pretend it was only visiting. So I asked myself, if I liked the stock at the higher price, shouldn't I love it at this price? That sounded logical, calm. It wasn't. A cheaper stock is not automatically a bargain. Sometimes it's cheaper because the company has become worse. But I didn't want analysis. I wanted emotional support from a green candle. So I bought another $3,000. For 2 days, the stock recovered. I thought I had timed the bottom perfectly. I was back. The genius had returned. Then the next announcement arrived. A major customer canceled its agreement. The company also admitted that production would be much lower than expected. The stock fell 27% in one day. I watched thousands of dollars disappear before lunch. Usually lunch is disappointing because someone forgets your sauce. This was worse. I searched everywhere for a positive explanation. One person said the canceled contract didn't matter. Another said a larger customer would replace it. Someone claimed powerful institutions were manipulating the price to scare small investors. That explanation became extremely popular because it removed all responsibility. The company wasn't failing. The market was cheating. Management wasn't making mistakes. Mysterious billionaires were trying to steal our shares. And apparently, if we sold, the billionaires would win. So I held. Not because the business was improving, because selling now felt like surrender. Eventually, I stopped checking my total return. I focused only on how many shares I owned. More shares felt like progress. I celebrated reaching 100 shares, then 200, then 300. I ignored the fact that those shares were worth less every week. It was like celebrating that your sinking boat had more chairs. I also stopped talking about the stock with people I knew. Earlier, I had told friends it could change my life. Technically, I was still correct. Just not in the direction I expected. Whenever someone asked how the investment was doing, I changed the subject. The stock was down 70%. My original reason for buying had fallen apart, but I created a new goal. I didn't need the stock to reach its old high. I only needed it to return to my average price. Then I could escape without a loss. That became my entire strategy. Not making money. Not evaluating the company. Just getting back to even. Then came the announcement that finally destroyed the illusion. The company was running out of cash. It warned investors that it might not survive without more financing. The stock dropped below $1. Then it received a warning from the exchange. If the price stayed too low, the company could be removed. The stock people once predicted would reach $100 was now trading for less than a vending machine snack. My account showed a loss of more than 90%. I opened the online group. Most of the familiar names were gone. The people who told everyone to hold had stopped posting. The investors who claimed they were buying every dip had disappeared. The community that once felt unstoppable had become almost silent. But a few people remained. And unbelievably, they were still saying the same thing. This is the final dip. The comeback will be legendary. Life-changing opportunity. For the first time, those words didn't sound hopeful. They sounded desperate. I finally opened the company's financial reports without searching. For someone else's interpretation, what I saw was obvious. Revenue was shrinking. Debt was growing. The company kept issuing more shares. Executives had missed almost every major target. The business I believed I owned existed mostly in future promises, and those promises kept moving further away. The information had been available the entire time. I simply ignored anything that threatened the story I wanted to believe. I didn't keep buying because the company became more attractive. I kept buying because each purchase made it harder to admit the previous purchase had been wrong. The more money I invested, the more emotionally committed I became. I thought I was demonstrating conviction. In reality, I was protecting my ego. I sold the position. Not at the bottom. Not before another recovery. Not after getting back to even. I sold while the account was still showing a devastating loss. After investing more than $15,000, I recovered less than $2,000. I expected selling to feel unbearable. Instead, I felt something unexpected. Relief. For the first time in months, I didn't have to defend the company. I didn't have to search for positive news. I didn't have to convince myself that the next announcement would change everything. The loss was painful, but uncertainty had been worse. I had spent months watching the stock control my mood, my attention, and my decisions. Selling didn't return my money, but it returned my ability to think clearly. Buying a dip is not automatically a strategy. It only makes sense when the reason you bought the investment remains strong. A falling price and an undervalued company are not the same thing. Sometimes a good company becomes temporarily unpopular. Sometimes a bad company is slowly being exposed. The difficult part is knowing the difference. I also learned that averaging down increases a risk. It doesn't erase it. Every additional purchase should be treated like a completely new investment decision. If I didn't already own the stock, would I buy it today based on the current facts? For months, my honest answer would have been no. But I kept buying because I already owned it. I wasn't evaluating the future. I was trying to repair the past. People love saying, buy the dip. It sounds disciplined, confident, almost guaranteed. But nobody tells you that some dips keep dipping. Some stocks never return to their highs. Some companies never recover. And sometimes the bravest decision isn't buying more. It's accepting that the story changed. I bought every dip because I thought patience would eventually reward me. But patience without evidence is not discipline. It is denial. So before you buy the next dip, ask yourself one question. Are you buying because the investment has become more valuable? Or because admitting you were wrong feels more painful than losing more money? Because I kept waiting for the stock to come back. It never did. And by the time I accepted that, almost all my money was gone. Subscribe for more investing stories about money, risk, psychology, and the mistakes people rarely talk about. And comment below. Have you ever held an investment for too long because you were waiting to get back to even?